Hello, students. You are welcome to today's class, and you are welcome to Study Good Academy All. Uh, you are welcome to our digital class. Here, we shall be looking at international taxation. International taxation is a course taken at Professional 2 of the Chartered Institute of Taxation of Nigeria, and that is we want to we like you to know much about taxation throughout the world in other jurisdiction. Okay, so you should know how taxes is what is being effective in other jurisdiction, and particularly now we are in a digital world whereby transactions are being carried out using digital form. Okay, so that is our digital economy exactly. So now there is need for you to know how jurisdiction to jurisdiction, that is tax authority in different geographical location in different countries, relates with each other. Okay, how they relate with each other. Okay, so now we are looking at the following topics under international taxation. Okay, so firstly we shall be taking international tax policy, international tax policy. Okay, and also we shall be looking at residence, and also we shall be looking at double tax treaty, double tax treaty. Okay, and also we'll be looking at okay so we shall be looking at concepts of permanent establishment, concept sorry we shall be looking at concept sorry we shall be looking at concepts of permanent establishment. Okay, and also we'll be looking at concept of transfer pricing and Nigerian taxation. We'll be looking at sorry we'll be looking at concept of permanent establishment, and also we'll be looking at concept of transfer pricing and Nigerian taxation. Concept of transfer pricing and Nigerian taxation, and also we'll be looking at effects of offshore judicial decisions, effect of offshore judicial decision, and also we'll be looking at Citn capitalization. We'll be looking at Citn capitalization and Nigerian taxation and Nigerian taxation. Okay, sorry, and Nigerian taxation. Okay, and also we'll be looking at international. We're looking at international what? International tax avoidance, sorry, and Nigerian taxation. International tax, sorry, tax avoidance and Nigerian taxation. Okay. So in short, these are the course outline, okay, or course contents. So we shall be looking at each of these one after the other. Okay. We shall be looking at them one after the other. Okay. International tax avoidance and Nigerian taxation. Okay, so that's that. Are we together? So now, my name is Ogunowo Abdeganiyu. So I will take you throughout this course, and I wish you best of luck. And I pray, may God grant you more wisdom, knowledge, and understanding as we go on in this class. Okay, exactly. So I would like you listen attentive and make sure you avoid any means of distraction while learning. Okay, because this is a digital class now, and also you can always play back whatever you miss, or if you feel like you don't get it the first instance. Okay, so you can always go back to uh to the notes. Okay, by reversing. Okay. Now, let's start with international tax policy, which is our chapter one of this course. Okay, so now international tax policy. Under this topic, we shall be taking introduction to international taxation, and also we'll be taking objectives of international tax rules, and also taxation of inland and outward investment. And it is also essential to define some key terms such as active and passive income distinction, portfolio investment, double taxation, source and residence tax jurisdiction, okay, and also controlled foreign companies. Okay, and also we shall discuss taxation and public international law. We shall look at history of international tax law. We discuss jurisdiction to tax, including limits to tax jurisdiction arising from public international law, that's under taxation and public international law. Also, we are going to discuss rules of public international law governing the assessment and collection of taxes, cross-border enforcement of tax debt, introduction to international fiscal policy, and international settlement of fiscal disputes. Also, we'll be looking at international fiscal policy and income profit taxation, causes of international double taxation of income profits, under which we are going to discuss conflict of residence and source, conflicting definitions of connecting factors, other causes of international double taxation, including particular issues for using citizenship as a connecting factor for taxation. Okay, and likewise, we'll be looking at methods of relief from international double taxation. Relief by credit will be discussed under this part, and also we are going to take relief by exemption, practical difficulties in applying relief by credit and relief by exemption, and also relief by exemption and relief by credit compared by taking the difference between, or by explaining what capital import neutrality is and capital export neutrality. Okay, and under that part as well, that is other methods of relief from international double taxation. We shall be discussing other methods of relief from international double taxation, such as relief by deduction of foreign tax and relief by deferral. Are we there? Now, also, we shall discuss international fiscal policy and indirect taxation. Under this subtopic, we'll be looking at causes of international double taxation of indirect taxes, such as VAT, withholding tax, and the likes, and origin and destination basis of taxation. We shall also discuss relief for international shipping and airlines companies, World Trade Organization, General Agreement on Tariffs and Trade, and General Agreement in Trade in Services and their relevance to taxation, WTO, GATT, and GAT. Okay, and finally, lastly, we shall take international cooperation between tax administrations, under which we are going to discuss international cooperation by bilateral agreements, analyzing the model of agreements on administrative cooperation, or analysis of model agreements on administrative cooperation, and finally, to end it up, we are going to take multilateral cooperation between tax administrations. Mind you, the syllabus or the course content might look quite uh, voluminous, but I would like you to take your time, because we are going to be discussing how taxation being arranged, okay, or managed, planned by multinational companies, okay, and how do each tax jurisdiction that is in a specific country, country specific, relates with each other. Is that clear? So that's why it's so voluminous. But just take your time, rest your back, and listen to the lecture while I take the class. Is that clear? Now, as promised, we are starting with chapter 1, and the topic to discuss is international taxation. Okay, so join me. This chapter has been split into parts, and we are having our part 1 first. Now, we are going to start with introduction to international taxation. That's first on the list I have here. Introduction to what? Introduction to international taxation. Now, systems of taxation vary among governments, right? So making generalization difficult, specifics are intended as examples and relate to particular governments and not broadly recognized multinational rules. Yes. You know, as taxes may be levied on varying measures of income, including but not limited to what? Not limited to net income, under what? Under local accounting concepts. In many countries, this is referred to as what? To as profit. Okay, so it's referred to as what? To as profit. Also, we have what? We have a gross receipts. Okay, we have a gross receipts, gross margins. Okay, we have gross margins. That is sales less cost of sale, or specific categories of receipts less specific categories of reductions. Unless otherwise specified, the term income should be read broadly. Now, when we say income, it depends on the tax person. Okay, so it depends on who the tax person is, that is the taxpayer. Are we together? So if the taxpayer is an individual, okay, so tax will be charged on his what? On his income. Okay, tax will be charged on what? On his income. And also, if the taxpayer is a company, okay, if the taxpayer is a company, you know that profits should be charged on what? Profit should be charged on such company profits for the year. Is that clear? So profits for the year, and which should also be classified as income to the company itself, isn't it? So jurisdiction often impose different income-based levels on enterprises than on individuals. Okay, so entities are often taxed in a unified manner on all types of income, while individuals are taxed in differing manners depending on the nature or source of the income. Okay, so many jurisdictions impose tax at both an entity level and at the owner level on one or more types of enterprises. Okay, so these jurisdictions often rely on the company law of that jurisdiction, or that that other jurisdiction. Okay, they often rely on the company law of that jurisdiction or the other. It was in determining whether the entity, that is whether an owner, are to be taxed directly on the entity income. However, there are notable exemptions, including the United States rules characterizing entities independently of legal form. Okay, so managers of entity or the shareholders are tasked independently of the company they are managing or of the company they own. Okay, so on all dividend they receive, they will be charged what? They are paying withholding taxes, while the directors or employee that manage the business, the company, will also be charged on personal income taxation. And why the company profits, okay, before distribution of dividend as well, will be charged for company income tax. So in order to simplify administration or for other agendas, some government have imposed deemed income regimes, and these regimes tax some class of taxpayers according to tax system applicable to other taxpayers, but based on a deemed level of income as if received by the taxpayer. Are we together? So disputes can arise regarding what level is proper. Procedures for dispute resolution vary widely, and enforcement issues are far more complicated in the international arena. In the what? In the international arena. So the ultimate dispute resolution for a taxpayer is to leave the jurisdiction, taking all property that could be seized, and for government, the ultimate resolution may be confiscation of property, incarceration, or dissolution of the entity. Confiscation, okay, or what? Or dissolution, okay, or dissolution of what? Dissolution of the entity. Now, there's disputes. And for the taxpayer, the best thing to do is to leave that jurisdiction, because the general rule of tax is that the taxpayer should not pay more than what he or she would have paid under normal circumstances. Okay, and there's nowhere in the world that a taxpayer will be willing to pay over and above what it is expected to pay. Okay, so that's why uh, other major conceptual differences can exist between tax systems. These include, but are not limited to, assessment versus self-assessment, means of determining and collecting tax, that is, using the best of judgment by the tax authority, and the tax payer himself or herself using self-assessment. So, methods of imposing sanctions for violation, sanctions unique to international aspect of the system, mechanisms for enforcement and collection of tax, and reporting mechanisms. Are we together? Am I speaking sense? So therefore, international taxation is an aspect which determines tax payments on business or through investments conducted by what? Through investments conducted by legal person or an individual person in cross-border where by tax laws of any interested state to tax or international law may be applicable. Okay. Furthermore, international taxation is the study or determination of tax on person or business subject to the tax laws. It is the study or determination of tax on a person or on a business subject to the tax laws of different countries or the international aspects of an individual country's tax laws as the case may be. Is that clear? So governments usually limit the scope of their income taxation in some manner territorially or provide for offsets to taxation relating to extraterritorial income. Are we together? So under international taxation, it might happen where two countries, okay, where two countries are what are interested to tax a person. Okay, so we have country A and we have our country B. They are both interested to tax what? To tax Starry good. Okay, they are both interested to start what? To tax Starry good. Okay, so and this is where a conflict or dispute arises. Okay, tax conflict or tax disputes arise in this case because Starry good cannot pay to these two countries because it has an implication if such should happen. Okay, so you can't expect, okay, maybe at the end of the year Starry Gold and an income worth $100 million, okay, or let's say naira, we are in Nigeria, right? That's good. Nigeria, I'm proud of my country. So 100 million naira to Starry Gold at the end of the year. And you know, for the fact that Starry Gold has no physical class, he Starry Gold goes digital. So we have customers across the world. Okay, so Starry Gold has customers, and who are Starry Gold customers? They are students. Okay, so now these students from at their leisure time, from the angle of their home, they consult Study, go get their video lectures, listen to them, go for their exams, they write their exams and pass them. Okay, so they are always successful in the examination, and that's the reason why students always come back or refer their colleagues to Study Gold to get their videos. So at the end of the year, Study Gold has generated an income of 100 million. Now, this country, England, they are interested because Starry Gold has generated some income from their citizen. Okay, Starry Gold has generated some income from their citizen, and here Nigeria, country B, where Starry Gold has its head office. Okay, here in Oregon, is also interested, Nigeria is also interested in what? In taxing Starry Gold on what? On income generated here in Nigeria. Now, it's either country A, okay, is either country A overlook or or speak with country B. They should make an arrangement on how or sorry, they should put in place some criteria, some methods, okay, how Study Gold will not end up paying more than what it's expected to pay other normal circumstances, because there is issue of double taxation. Now, if the tax rate for company A is 20% and that of country B is 30%, Starry Gold will rather or we prefer paying to country A and what and exempt country B, okay, because tax country A is what has a low tax jurisdiction, and why country B is a what is a high tax jurisdiction. Okay, so Starry can claim that, oh, most of his income are generated from country A, therefore he is liable to country A. Okay, so now let's move further. Are we together? So let's move further. Under international taxation, it might happen where two countries, okay, it might happen where two countries we are what are interested in what in taxing in taxing a person or an individual or a company, and this is where conflict arises. So there are a number of conflicts which can arise in international taxation, and these are such as source conflicts, okay, source conflicts, that is where the income is being generated from, and residence, okay, residence conflicts. So where what? Where the head office or the management that controls the business resides. Okay, like the case of Starry Gold. Starry Gold has its head office here in Oregun, Lagos, Nigeria, but most of its customers are located or reside in what? In England. Can you see? So his source of income is what? Is England, while his residence is what? Is Nigeria. Are we together? So there are a number of conflicts which can arise in international taxation. These are such as source conflicts where two states claim that the source of income comes from their country, and residence conflict, which is residence source conflict, income characterization, also income characterization, okay, and conflict and entity conflict are stated by tax justice network. Okay, so therefore, due to these conflicts, state found it necessary to form some agreements on how to deal with tax collection having foreign nature. Having foreign nature. So that's why there are many conventions. We have and also we have double tax treaty. Okay, we have multilateral conventions, we have bilateral conventions and the likes. Okay, so so as to reach some agreement or form some agreement on how to deal with these international issues on taxation. Is that clear? So now let's look at the objectives of international tax rules. What is the objective, or what are the objectives of international tax rules? Taxes are not international. Do you agree with that? Yes. Why? Because a specific country or country specific as its domestic tax rule. Okay, as its domestic tax rule, and there is no international tax rule. Okay, there is no international tax rule. But we have treaty. Okay, we have tax treaty. Is that clear? We have tax treaty. Okay, so the reason being that the way we do here in Nigeria is quite different from how they do over there in England. Is that clear? So, and if you notice that there's no where in the world, or there's no each country has its unique tax rates, especially for companies. Like in the case of Nigeria has the lowest uh, company income tax rates in Africa. Is that clear? So it has the lowest company income tax rate of 30% in what? In Africa, and most parts of the world. Is that clear? And also for personal income tax, you can see in the case of Nigeria, we have what? Uh, 5%, okay, 7%, 11%, and the likes. So you get to 24%. Is that clear? Am I making sense at all? Sorry, you start with 7% rather. You start with 7%, 11%, 14%, we have 21% and 24% and the likes. So look at and in some other countries it is not that. Okay, so taxes are not what they are not international. There is no separate global tax law that governs cross-border transactions. Moreover, there is no international tax court or administrative body for international tax issues. All taxes are leveled under their domestic tax law or under their domestic law by federal, national, or local governments. So these tax laws have an impact on cross-border transactions. Therefore, international taxation governs these domestic tax rules under customary international law and treaties. Customary international law, customary international law, and what? And then treaties. Okay, so international taxation also supports other objectives of domestic tax systems. So now, what are the objectives of international taxation? These objectives normally include measures to promote fairness by imposing equal tax burdens on domestic and foreign taxpayers with equal income and ability to pay regardless of the source of the income. Yes, you should be fair to all individual, okay, and also do they have the ability to pay. You don't just impose taxes on individual or on citizen living in a territory, okay, so you should consider their ability to pay. So if they have no if they could not avoid, okay, paying at the rate of 25%, you should consider them by bringing it to 50% if that is what they can avoid. Okay, if that is what they can avoid paying, so that there will not be to reduce the amount of disputes to reduce the amount of disputes between the tax authority and the individual citizen. Okay, so also another measures or objectives of international tax policy is to enhance domestic competitiveness through fiscal measures and to promote economic growth, to obtain a fair share of the revenues from cross-border transactions, and to ensure an equitable balance between capital exports and capital imports. Neutrality. Okay, so because there are some investors that source for their capital, the source for finance of their business, especially companies in the industry, in the oil sector, uh, to finance their project, their business. Okay, so this uh, is referred to as what? Capital import neutrality. Okay, sorry, capital imports. Okay, let's put it that way. Capital imports. So there should be neutrality. That is because paying back this loan, the tax and these investors should be allowed to pay through Central Bank of Nigeria, so as to take advantage of forex. Okay, compared to using other domestic like these what are they called, uh bureau de exchange, okay, and the likes, so that to reduce the cost implication. So the principles of international taxation are influenced by tax equity and tax neutrality within the national economic sovereignty of each nation. And tax equity requires that the tax revenues from international economic activities be shared equitably by nations. Okay, so it also requires that taxpayers involved in cross-border activities be neither discriminated against nor give undue preference in their tax burdens. Are we together? So tax systems are neutral when they do not influence the economic choices of tax payers. Exactly. So also they may be tax neutral. Okay, they may be what? They may be tax neutral either on what? On exports, capital exports, or on what? On capital what? On capital imports. Okay. So developed countries tend to favor capital exports or domestic neutrality, under which the taxpayer's choices between investing at home or what? Or abroad remain unaffected. Okay. That is what we call world efficiency. World efficiency. Okay, that is what we call word efficiency. So on the other hand, developing countries generally prefer capital imports, that is, go and source for finance out the country and bring them in. Okay, so, or we call it competitive neutrality. Okay, competitive neutrality. Okay, so to ensure that the investment decisions of domestic and foreign investors in their country are on par, that is national efficiency. So while capital exports is to promote world efficiency, capital imports is what? Is to national efficiency. Are we together? Okay. So the fairness and efficiency of tax systems depend not on the tax laws of any one country, but on the cumulative effects of the tax laws of all countries. As there is little global tax harmonization, domestic tax systems often conflict on cross-border transactions and lead to excessive taxation. Are we together? Okay. So countries are what? Countries are at differing levels of social and economic growth with varying physical needs. Each country applies its own taxing rules to transactions connected with its jurisdiction. So the lack of a common view on international tax principles creates economic distortions. Creates what? Creates economy distortions, okay, and also encourages international tax competition. Okay, therefore, international taxation attempts to resolve these conflicts through the principles of enforceability and reciprocity. Countries may have unlimited rights of taxation over a person or object, but they cannot normally enforce them outside their own jurisdiction. Okay, so the attempt to resolve this conflict through the principles of enforceability and reciprocity makes countries have unlimited rights of taxation over a person or object, but meanwhile they cannot normally enforce them outside their own jurisdiction. Therefore, they must respect the reciprocal taxing. They must respect what? They must respect the reciprocal taxing. Reciprocal taxing. Okay, they must respect the reciprocal taxing rights of other countries and cooperate with them to evolve rules of taxation that meet their mutual physical objectives. That means that what? That means their mutual physical objectives. Are we together? Okay. So we are progressing, right? Now we are stopping here. When we come back, we start from part two, or we start with part two of this same chapter, international tax policy. Goodbye.